All right, so welcome everybody. We've got some new faces, which is really exciting. Hopefully, we don't scare you away. And that is, here we are. Okay, and so welcome to Enhancing the Accountant Bookkeeper Connection series. Webinar has already begun, so that's fine. We'll just slideshow it. So, for those who don't know me, I am Tanya Hiltz, and I am here because I am passionate about collaboration. And you can find me at Tanya's Bootcamp on all of the social media channels. I'm not going to go through all this. A little bit about me. I know there's some new faces, so I will just say I am a certified professional bookkeeper. I have was awarded with my fellow 2 years ago, I believe. I also have my accredited impactful advisor and level 5 certified advisor designations. I have some industry accolades. The most notable, which actually, okay, it's a little further down. I'm like, I took that off, is being Intuit's Global Firm of the Future for 2018. I will just say that we were also the last firm of the future. We broke the contest. They got sick of Canada winning it 2 years in a row. So I also get to say that I am the reigning global firm of the future, which is a pretty big deal. And then, like I say, some other well-known industry accolades. I'm not going to go through them all. Um, Alone we can do so little, together we can do so much. And that is one of my favorite quotes from Helen Keller. I use this and reuse this quite a bit, especially on this series, because this is about the collaboration. So Jonathan, who is going to be taking it over, is my friend, fellow collaborator, as well as my accountant, and we together have learned so much. We have totally different firms. We both offer bookkeeping services. We both offer personal income tax services, so there are some competing services, but we don't look at it that way. And we have worked together for many, many, many years, trying to educate everybody and trying to bring the collaboration through. And I will just say, Jonathan is actually the first accountant that I met that I actually had respect for. And what that told me was I was hanging out with the wrong accountants. I was hanging out with the accountants, who they weren't my people. They didn't look at things the same way as I did. So if there's any accountants here on the call who have bookkeepers that they don't respect, it's the same thing both ways. I've learned that there are good and bad in both professions, and it is the people. And thankfully, Jonathan was able to show me that. But going back to this, continuing education credits, this does qualify for CPD. Absolutely, through CPB Canada. We do hit all of the prerequisites through CPA and the US organizations as well. We're just not pre-approved, where CPB is pre-approved. There will be two polls that must both be answered in order to qualify for those credits, and the recording of the webinar and the credits will be mailed within 2 to 3 days. Absolutely. You must be subscribed to receive your recording and your credits. If you don't receive it within 48 hours, don't forget to check your spam first. If there's any issues, you will need to resubscribe. And there's the instructions on doing so, or reach out to me. When we've sent it out is when it gets uploaded on YouTube at the same time. Reach out to me directly at bootcamp@mycbs.ca and we can walk you through to make sure that you get that. But if you unsubscribe, you will not hear from us again, which includes stuff you may want to receive. So just remember that. But we're not spammy at all. Okay, so featuring Jonathan. So I've already talked a little bit about Jonathan. He is the founder and principal accountant of Acada Accounting Solutions. We have been collaborating with Jonathan and his team for a number of years, and I think this will probably be a lifetime, or at least both, as long as both of our businesses are in existence, to continue to collaborate back and forth with things to, better our processes and whatnot. We've just spoken on something that we're going to be using ChatGPT for potentially, and we're using my file because again, he's my accountant, to see how that goes and how that works for his team, which will impact the flows that we have for all of our year ends. So no pressure or anything, Jonathan, there for you. But it's like I say, it's an ongoing collaboration, and I absolutely love it. We have multiple mutual clients together. What I love about Jonathan is his team is they work in QBO and they have attention to detail, which does make it a lot easier. So we don't get, those questions from some accountants who might not understand why a journal entry just to AP without knowing where we need to make that adjustment to or what client, it adds a little bit of frustration, and that's a miscommunication and something that, hopefully we can, as an industry start to pull together on with that as to communicate that. But it's because we do different things at different levels, and that's it. But that makes it easier for us. So that's why we love Jonathan and his team's attention to detail. And of course, they have outstanding customer service, which falls in line with what we offer our clients as well, too. We want that to be consistent. So I am going to stop talking now. I'm going to stop sharing, and I'm going to let Jonathan take over. And this is an open format. So if anybody is, comfortable than want to speak, please go ahead and just, throw your hand up, just jump in. It's like I say, it's really informal here, but this will be recorded and put up. So if there's anything that you don't want recorded, please try to remember to either let's wait till after we stop the recording or ask me to pause the recording so that I can guarantee it gets edited out. Anyway, I will stop talking. Jonathan, please take it over.
All right. So thank you very much, as always, for a wonderful introduction. Um, am the founder of CATA Accounting Solutions. I was a member of the inaugural Intuit Accountants Council, and I still do some work with Intuit. Now it's mainly on the tax side. I've received some great awards over the years, top 100 lists, Inspire Accountant Award, but the one that we're most proud of is the 2023 CPB Firm of the Year. That was that was really, it was a surprise, and it's definitely the biggest accolade we've received.
Well,
I
sorry, I'm just
sorry.
going to jump in. I'm going to say it's a lot because just while bookkeepers are detail oriented by nature, we're also very particular as to, the passing that out to an accounting firm. So I think that just speaks even more towards the level of service that you
Thank you.
guys bring in and offer. So it's, yeah, very, very proud of you for that too.
I'm having a little bit of difficulty with my Zoom right now in that I can only see the presentation. I can't see everybody. So I'm going to stop sharing periodically when I want to see people as we go through. I'll just wrap up by saying that, we love collaborating with people in general. So we do actually do work for a lot of bookkeeping firms. So today we're talking about succession planning and preparing for your exit. Very exciting topic. Everybody loves to think about their own death. It's wonderful stuff, but it is really one of the big things. And in retrospect, I really wish I'd picked a better quote for the end, but we'll get there. So just a quick show of hands. Who here is in the United States? I see no hands up for the United States.
We do have Beth. Beth came
Okay,
in. Yeah, Beth is in the States. I know that for a fact. Um, and that's all that I know for a fact.
So Beth, I apologize. Some of this is very Canadian centric, but the principles are still going to apply. It's just the rules might be different, of course, from state to state. Beth is in Saskatchewan. Okay. All right, so no problem. So okay, so it will relate to you.
Oh, is it?
So
Oh, I'm sorry, Beth. I thought you were, never mind. I've got you confused with somebody else. My apologies. All right. Sorry. Keep going.
So just as a quick show of hands, who has a succession plan idea? They have an idea of what they want to happen when they retire, when they die. Who has an idea? Okay, so we got some people who have an idea. Now, who actually has a plan? Yeah, I'm not even putting my hand up for that. My will needs to be updated. But I hope this is going to be a very useful session. This has been something that I've been talking about a lot lately. And
I have a will.
that's a great start. I have a
I,
will
I
too,
had to when I
but it hasn't been
divorced. I had
updated
to
since I
redo
got
my will
married.
personally and professionally.
Yes, we'll get to
So,
that too.
the only thing I got done.
So let's get into it. So we're talking about preparing for your exit. That's more than just your death, right? It could be selling the firm, passing the firm to succeeding generations, things like that. Again, some of the tax stuff is going to be very Canada centric. But and I'm not talking about any specific provincial items. So in each province, you're going to have to kind of investigate these things and determine, what the steps are for you. So we're going to talk about exit strategies. I think this is very important. I think it was the Seven Habits book where he said start with the end in mind. And really, that's why it's CATA Accounting Solutions and not Jonathan Carter CPA Professional Corporations. CATA Accounting Solutions, because I wanted to be a brand that was transferable and saleable. So exit strategies we're going to talk about. We're going to talk about a few key considerations, how to prepare for your exit, what happens when you exit, and of course, everyone's favorite, taxes. So let's kick it off with the poll. When I want to retire, I will A, sell the assets of my business, the book of business, sell the company, B, sell the company to an unknown buyer, C, close the doors, D, pass it on to the next generation, or E, sell to my employees. This is 100% subjective. And I can't see the poll question, so I'm going to just stop sharing. So hopefully I can. And you'll have to be able to
No,
make it so that all
it's
panelists.
not you. I shoot. So keep sharing. I added it, but I changed my account and it did some changes. And so therefore it's not actually available. So I'm just going to add it real quick. So how many choices did you have? A, B, C, D, and E, or just
Yeah,
D?
yeah. A, B,
Okay.
C, D, and E.
Okay.
Kim, I'm curious. What
You
if you're
won.
planning
Okay.
any of
So I'm just going to post this again. So you have to look at this. And save as a meeting poll.
them? Sorry.
Jonathan, while she's setting that up, I'm off cam because I'm eating my lunch, but my plan actually isn't to ever get rid of or sell my business, but rather just to hire staff to run it for me when I'm ready to not work anymore. That's my
And
plan.
then what? What
And
happens?
She's
oh,
gonna
and
live forever.
when something actually happens to me, you mean?
Yeah,
Oh, yeah, I didn't think about that part.
something to think about. Something to think about. Hopefully, this discussion will generate some ideas and help people plug holes in their plan. Diane.
Yeah, I have a question. Can I see the poll question? A, B, C, D,
Sorry.
E?
Oh yeah, sorry, you have to screen share again. Sorry. Yeah, just because
Sorry,
I have to
I
have
can't. I don't know why. I just can't see people when I'm screen sharing. It's really weird. I've never had that happen before.
Okay, we've got 14, have 15. So we'll count down. We'll give people 5 more seconds and then we'll close the poll. Remember, both poll questions must be answered in order to get your credits.
Tanya,
So yeah.
sorry, I just want to let you know that you can't actually, or I couldn't. I actually had to get the QR code in order to answer the actual question itself. Like you couldn't,
Really?
I couldn't just, yeah.
I did.
And
Okay,
I
that's
don't know if that's because I'm a co-host or if
I
that's,
clicked it and I didn't have a problem.
I didn't have any problems either.
maybe because you're a co-host, because I just see get QR code. So that's probably why, Sandra.
okay.
So you'll have to just write it into the chat.
I
Like
just
you're
used the
speaking.
QR code. It's fine.
Okay, perfect. Okay, awesome. So we will close it down. 5, 4, 3, 2, 1. We'll end the poll and then share the results. And then I'll try to get the full second one typed in and set up under this. No, yeah. Anyway, so there it is. So it seems to be even between D and E.
I love all the variety of ideas. I hope that the person who answered that they're going to close the door changes their mind because your life's work has value. Your life's work has a lot of value, and I hate to see that you would not be compensated for that ever. Even selling the assets, selling the book of business is better than.
Yeah, like you just closed the doors. You just basically ghosted all your clients.
Well, we're going to get to that, but yeah, that's
Yeah.
part of it. It's not ghosting. I mean, maybe you're trying to get them into good homes or whatnot, but really, you spent years developing processes, developing relationships, and developing your business. In my opinion, you built an asset and you deserve to be compensated for that asset. At least a little bit. At least a little bit. I'm just going to do a quick change up with my setup here. Okay, good. So, let's talk. Oh, my screen is weird. Okay, there we are. So let's talk about some potential exit strategies. A share sale, if you're incorporated, you have the possibility of using a lifetime capital gains exemption. You need to have qualifying small business corporation shares to get that. You could go public and possibly trigger the Canadian Entrepreneurial Incentive, or you could sell to an employee ownership trust where the incentive is the highest at $10 million, a capital gain exemption. So let's hope that we're all selling for that $10 million, but I think realistically, we're looking more at a possible share sale or an asset sale. So an asset sale, you're selling the assets of the business. There's a capital gain for the business upon which the business has to pay tax. And then you would dividend out whatever's left to yourself and then dissolve your corporation. Now, if you are a self-employed person, you cannot do a share sale. You can only do an asset sale. And we're going to get into some of the stuff that you can do to prepare for sale and kind of take advantage of some of those tax areas that can really help. And of course, the final option is to just shutter the business. Just close it up, say, sorry, y'all, I'm retired, I'm out, and then just drop the hammer and good luck to everybody. So there's different considerations to take into account in each one of these scenarios, and we're just going to go through them. So a share sale. You could sell to a private buyer. Recently, in the last bullet, private equity has entered the bookkeeping and accounting market. There's positives and negatives to that. And some of this feedback I've got from business brokers. In particular, I like talking about this with business brokers who specialize in the accounting and bookkeeping industry. And what they're finding is that in the States, it's about price. So a lot of people are going to private equity because they're getting a bigger premium for their firm. Whereas in Canada, vendors, like the people who are selling their businesses, are more concerned about fit, right? Like, are you going to take care of my clients? Are you going to take care of my employees? Do we have shared values? Those kind of ideas, right? So there's a real discrepancy between, in Canada and in the States. Private equity is more involved in the United States, but there are some private equity deals that are happening on this side of the border. If you sell to a private buyer, actually, you know what? I'm going to hold off on that part. We're gonna get more into the tax bit in a bit. You could sell to your employees. You could be a couple of key employees where it's like selling to a private buyer, but you know them. You could sell the shares to a trust where the beneficiaries are the employees. Definitely a bit more complicated, but there's a huge tax incentive on that one. There are more hoops to jump through, and there's more planning to do. But of course, who would not like to get the 10 million tax free instead of the 1.25 tax free that we get from a sale to a private buyer or private equity. You could sell through a business broker, or you could do it privately. I've seen people sell through a realtor. I don't know about that because, what does your average realtor know about the industry? Personally, when I go to sell, it's probably either going to be an employee ownership trust or it's going to be through a business broker. And I think paying for their fees is well worth it. The key is with a share sale, you have that possibility of the lifetime capital gains exemption. You don't have that possibility if you're selling the assets. So if you sell the assets of a corporation, the capital gain inclusion rate will be 2/3 will be included in calculating the tax owing. However, we're all we've all educated ourselves, I think, as professionals about what came out in April. It still has not received royal assent. So right now, there's still a question as to whether or not this will actually happen. Of course, it's my hope that it doesn't, because I think it will stifle investment in Canada. And already, Canadian startups are getting $1 of funding for every $43 a US counterpart is raising, which means that there's more incentive for a Canadian startup to emigrate to the US to raise funding. So that's something that's, I'd like to see it go away. Anyway, if you're an individual, you have a 50% inclusion up to $250,000 and 2/3 inclusion after that. That means as an individual selling your assets, you're going to pay less tax than if you're going to have less income included to calculate tax than if you're a corporation. Now, as a corporation, it could complicate dividend accounts a bit. It depends on your situation. The taxpayer is going to pay tax on the dividends when they withdraw the money, and the corporation is going to receive a bit of a refund to help offset the tax if there is room in that specific dividend account. I'm not going to get into RDTOH, NERDTOH, capital dividends. I'm not going to get into that right now because it's definitely beyond the scope of our discussion today. So the third option is to shutter your business. I don't want to see people do this. When I first started my firm, I did some research to see what a businesses are worth. And at the time, the average was 50% of revenue, 50 cents on the dollar of revenue. And the big reason for that was because most bookkeeping and accounting firms just shuttered. They had no succession plan. They just, the owner would die, the corporation would get wrapped up by the poor inheritor or executor who'd have to deal with that. The clients and the team were left in the cold. Hopefully there was enough cash in the firm to pay out the severance to the employees. If not, I mean, that could create further complications. And it also allows other firms to scoop up your clients who are no longer being serviced without compensating you. So after getting that bit of information, does anybody have any comments or thoughts about, this is giving me something to think about?
Definitely gives me something to think about.
Okay. Okay. I have a little note here from Ross. Yes. So I'm going to tell a quick story. This was from the presenter at the CPA Small Practitioners Conference that I attended last week. His was a fantastic session. I'm probably going to go back and take his CPA certificate course. But what happened was there was a self-employed practitioner who was doing quite well, but was definitely using the business as a personal piggy bank. When he passed away, the business was not attractive to buyers because his P&L did not make sense, right? Like there was just a lot of, obviously he was a little liberal with his ethics. In the end, the family was able to get about 50 cents on the dollar for the book of business, but it took them a long time to do it. And the only reason it happened was because a few key staff had a good relationships with the family and stuck around. Because there was no plan, there was also a very large tax bill. So that's something else to keep in mind about what happens when you die without a plan. Thank you for sharing that, Ross. I appreciate that.
Al Noor was a friend of mine. And
Yeah, I've had this similar scenario. As a CPA registered firm, I definitely have to be a little bit more cautious about considering an acquisition. And I've had a few people come to me like, my dad's a CA who's been doing tax filings for 20 years, but now he has Alzheimer's and he's starting to screw things up. Will you buy his book of business? And you investigate, not a registered firm, no insurance, charging like stupid low rates. I can't buy that book of business. There's no value in it to me. I'm happy to help your clients, but from that actual discussion, we had zero conversion because he was charging $750 for a corporate tax return, and our prices start at $1,850.
I know
And
these prices start at
people were asking things like, are you going to pay my penalties? My taxes are late. It's like, why? No, I'm not paying your penalties. I just got into this conversation. So, anybody have anything other comments about share sale, asset sale, or shuttering the business? All right, let's power on. So my share bar is right in front of my title. Section 85 rollover. Has anybody heard of this before?
Yeah.
Okay, so we have some people have heard about it. What a Section 85 rollover is a transaction where assets can be brought into a corporation in exchange for shares and often a promissory. So let's say, for instance, there's a startup that's working with This is from one of our clients. There's a startup working with scientists. The scientists have a patent. They want the company wants to own the patent. They can bring that scientist in for a special class of shares, some common shares, and then you often a promissory note to pay back any kind of difference. I'm not going to talk about the specifics of that transaction, but that's something that can happen. When you go from being a self-employed person to being a corporation, you should do a Section 85 rollover. Now, the common thing I hear is, oh, why would I pay to do a Section 85 rollover? It's just me. The assets are going into my corporation. I own it all. The corporation is a separate entity. The work you've done to build your book of business creates goodwill. You should have an agreement that includes a price adjustment clause to make sure that if CRA ever comes back and challenges the value of the asset you brought into the corporation, that things can be adjusted without just here's a tax bill, right? These can be designed to be tax neutral if they're done properly. If they're not done, or if they're done improperly, the CRA can come back and say that's a tax benefit for the corporation. The corporation owes us this much money or something like that. And they can assign whatever value they want to. So I am hoping that there are some questions about this, because this is an important transaction, an important inflection point in the life of many businesses. Okay.
I got one for
Will
you.
can
Sorry.
Go ahead.
Yeah.
Do you have like I'm sort of in the beginning of all of this because I bought some clients from a retiring bookkeeper. So what do you recommend like I look for at this point when I'm just starting sort of to build this? Should
It's
I be
good.
determining what I want to do at the end and then work backwards, or what do you think about that?
I think goals trump all. What matters to you trumps everything. And yeah, start with the end in mind and be like, okay, this is where I want to be on this date. When do I have to do this? When do I have to do that? And so on, and just work your way backwards. Whether or not, Shannon, are you incorporated now, or are you operating?
I am not incorporated at this point. I'm not even at the point where it makes sense yet, but the goal will be, I guess, to be eventually. I mean, yeah.
Are you insured?
Yes.
Okay, that's important. A lot of people feel like you have to incorporate to give yourself a liability shield, but the liability shield in Canada is not nearly as strong as it is in the States. And I hate seeing people incorporate when they're bringing in like 100K a year, and
Yeah.
it's like it's too early in the process. You've incurred all this additional compliance requirements. You have to pay somebody to do the tax return, or like all these different things that are really not a big benefit.
Right.
Having a corporation can be a good tax deferral vehicle, but the principle of integration, the taxes are going to be roughly the same in the end, no matter what
Okay.
happens. That's the
Thank
way.
you. Yeah. Yeah. I mean, I'm a little obsessed with end of life planning, even though I haven't done a very good job of doing it, but thank you.
No problem. Ross, did you have something to?
Yeah, you were talking about Section 85 rollovers and goodwill. How is goodwill actually calculated these days? Like that is
All
that is
right,
such
so
an
that's
arbitrary comment, like such an arbitrary number. Like I swear to, like, do people just pull the number out of the air or what? How do you evaluate that? Is it based upon years or whatever?
so it could be based upon a lot of different factors. To get a true business valuation, you should use a certified business valuator. We have one we really like in the GTA for and again, valuations can range from like, okay, here's your basic to like, here's your very in-depth valuation. And it can range in price from like 5,000 to like tens of thousands, maybe even hundreds of thousands, depending on the size of the entity or what's going on. It is important that there be some degree of valuation made and it be documented so that if CRA ever comes back and says it's unreasonable, you can provide the paperwork to say, hey, this is how I calculated the value, or this is the report from the certified business valuator, things along those lines. I did recently receive advice that I should not be doing valuations because I'm not a CBV. I think that is very cautious. And I think that there are some situations where businesses like have very, very low value. And so their risk is very low, right? CRA is going to base any kind of inquiry on recoverability. So if like we're talking about a business that might be worth 50 grand, then it's a lot less risk than a business that could be worth 200,000, 600,000, something like that.
Yeah, because that's a question, because I'm looking at that because other client, like it's beyond just planning here. It's also Section 85 affects all of us with any of our clients that we get in the future. That was why I was curious about that. So
Sorry, could you repeat that?
sorry, this mic is not the greatest. I was just saying because it's beyond planning, because it's also, it affects, I was asking that question because it affects any clients we bring on board that have to incorporate down the line. So I was just curious about that one because I
Yeah.
bring in on a plumber and he's
Yeah,
incorporating.
it's a good conversation to have, and coming up with that valuation. It's not the back of an envelope. Most
Nope.
valuation models are built on discounted cash flows, adjusted for various other things. Like, say, for instance, a bookkeeping firm has a premium if it's in the cloud, right? An accounting firm has a premium if it's a registered firm. Those kind of ideas, right? So, like, if it's a handyman who's not really a licensed plumber, it's going to have a lot less value than somebody
Yeah,
who's
no
part
value,
of.
really. No, he's licensed plumber, the works, and he's
Okay.
his net last year was over 250K
Hmm.
personal. So
So
it's
he's
like
paying tax.
he's paying taxes. So that's why we talked about incorporating. But yeah, he's coming over. But yeah, I was just curious about that because also, well, whenever this stops,
Yeah.
I'm thinking 15
Uh,
years maybe.
yeah, that's I don't know what I'm going to do like for my timeline, but I know I have at least 6 years to go before I can even contemplate a sale. So, okay.
Thanks.
Yes, Lynn.
Gotta find that unmute button. Um, so when I incorporated, I didn't do a section 85, but I looked around and nothing I had here was new in any way, shape, or form. So I didn't bring out over any asset value. Does it matter?
Yes, because the asset value you brought over was goodwill. So Section 85s can be designed to be tax neutral, and they can be filed late. There is a penalty, but if they're tax neutral, that penalty will end up being zero.
Okay.
Now, how much was your book of business worth would really depend on the date when you incorporated, the top line revenue, and the type of business it was. Like if it was a traditional business, it would have a lower value than if it was a cloud business, things along those lines. Now, be aware there is exposure, but there is a statute of limitations. You might have passed that statute of limitations. I don't know the details about your business,
Okay.
but just be aware that there's potential exposure.
So I should pursue it somehow and start asking some questions.
Sorry. A little bit of coffee went down the wrong way.
Mm,
Yeah, I think it's worth having a discussion with your accountant
yeah.
about how much that exposure is and whether or not you should file now. Their advice might be to not file now because it's been 6 years and we don't want to raise their eyebrows, right? Or
Mm.
something.
Okay. Okay. Thank you.
No problem. Anything else about this? Okay. Gonna share screen and keep going. So lifetime capital gains exemption. This is one of the biggest potential tax deductions for Canadian business owners. Again, 2024 has not received royal assent. It is supposed to go to 1.25 million and stay flat with indexing to inflation resuming in 2026. I would like to see this increase. It's almost $1 million now, but heck, I'd love to see this increase. And people can take advantage of this who are not the primary business owner, like employees who've acquired shares during their work for the business. If it is a qualifying small business corporation shares and the business is acquired, they can take lifetime capital gains as well. And it's not a one-time deduction. So as that amount increases, when it goes from 971,190 to 1.25 million, if that receives royal assent, then I have clients who are going to benefit from that because they have deferred capital gains by hanging on to stock and not selling it, waiting for the exemption to go up a bit. I don't think any of us were planning on going up this much when we did those calculations, but that's really good news for them. Now, qualifying small business corporation shares, I'm just going to talk about it briefly. There are some tests that you need to go through to determine if they are qualifying small business corporation shares. The broad strokes are for 2 years, 24 months prior to the sale of those shares. It has to be owned by the person, and the assets in the business need to be predominantly active business assets. That is, assets needed to run the business. So if you have $200,000 in, I don't know, some kind of investment in your corporation, and then it's costing you, say, 100,000 to run the corporation for the year, you definitely have inactive assets there. You're definitely not going to have qualifying small business corporation shares. So it's just something to keep in mind, and definitely something to consult on well ahead of your exit strategy. Any questions about this item? Okay. Gonna keep going. It's really throwing me that I have to stop sharing every time I'm gonna see if people have questions. All right, so there are some other possibilities. Again, these are not necessarily law yet. I believe the employee ownership trust did come in, but I would have to verify that. So the Canadian Entrepreneurs Incentive, it's very unlikely any of us are going to experience that. There are very strict requirements. It kicks in after the lifetime capital gains exemption and has a reduced capital gain inclusion up to $6 million. That will happen, I believe, typically when it sells to, like, when the corporation goes public. Employee ownership trust, there's significant planning required. You need to get your employees on board. You need to, have somebody who can act as your trustee and administer that trust. And it is more complicated, but the exemption's up to $10 million. So I think there is an incentive. The government tried to create an incentive to transfer the ownership of companies to the hands of the employees. It's a very interesting idea. My firm's not there. I don't think most of our firms are there, but I think it's something that's a really interesting possibility, particularly the $10 million exemption. So preparing to exit. Couple key questions to keep in mind. When should you incorporate, or should you? Keep the corporation pure so that you have qualifying small business corporation shares. Document your process, secure your key team members, and think about what a buyer is going to want. Think about what the buyer is going to find attractive and do those things, implement those things. And of course, use all available resources. So there are a lot of good webinars out there that are much more in depth than this. There are courses out there that are much more in depth than this. The CPA succession planning course, you do not have to be a CPA to take that course. You just pay, I think it's like an extra $100 to take it. This is actually a really good time to circle back to what Carol mentioned and I were talking about at the very beginning, wills and powers of attorney. So everyone, no matter what their situation, should have at least one will and 2 powers of attorney. The will determine who's going to be the executor of your estate and what you want to happen with your personal assets. The 1 power of attorney will be for healthcare, for making healthcare decisions if you're incapacitated, and the other will be for financial matters. So somebody who will look out for your financial interest should you be incapacitated. Everybody should have those. I need to update mine, but at least I have something, right? As a corporate owner, you might want a corporate will, and you will definitely want some kind of instruction about what's to happen in the case of your incapacity or your death. Out of curiosity, are there any CPA registered firms here? Okay. So CPA is bringing in mandatory succession planning for accountants, so that if people die, they will, the clients won't be left in the cold. There is something that's going to happen to make sure that the duties of the firm get executed and the clients can be satisfied. So that is something that's coming down as mandatory in the future. They're predicting 2026. I hope it's not 2025 because I'm going to spend 2025 getting my house in order. I would not be surprised to see CPB follow this lead in the future. We have worked with several bookkeepers who have inherited clients because their bookkeeper passed away, and we've inherited tax clients because of tragic car accidents and things like that. So having a succession plan, I think it really serves you, it serves your inheritors, and it serves your clients and your team. So Shannon, I think I saw you had your hand up there.
Oh, I just that was to remind me to ask. This is kind of a weird question, and this is where I'm hicked up right now. I was trying to choose an executor for my will, and I had chosen my brother-in-law, but he's a U.S. citizen, and I was told by an estate planner that that wasn't a good idea. So now I'm having a hard time picking a person. So I was curious about, is it possible to pick like a professional entity to help with this kind of thing? Is that such a thing?
Yep. There are
Okay.
professional executors. They typically won't accept the job if the estate is not worth it. So they would have to be a higher value. One thing that's really important, something I want to work on, and I've been talking about it with Tanya for I think maybe 3 years now, that I think it was like during the pandemic, we started talking about it, about having a death manual. The break glass in case of emergency. Here's where all my crap is. Good luck. You definitely want somebody who's savvy and who's involved in your life, who's trustworthy as your executor. And you could do stuff like, I don't know, like if you're highly involved in a church, maybe you ask if there's somebody there who would, volunteer to be an executive, help you through and
Yeah. I mean, I feel like I feel as though I have accumulated a lot of non-savvy people, and when I go to turn to them to ask them for help, I had a friend who said she would, and then she decided it was too much for her potentially.
it's a lot of work.
Yeah. So
Sure.
yeah, so I've kind of been struggling with trying to narrow that down, but I just was curious about, but that makes sense that they would only want to take it on if the state is worthwhile for them. So thank you for that. Yeah, that's helpful.
And I mean, that's why an executor gets paid. It is a lot of work. It's a lot of work. Tracy.
So I have a comment on that paid part. I'm the executor of my aunt's will right now, and boy, let me tell you, it's been a learning experience. Unfortunately, for the last several years, I have been trying to get her to get to a lawyer to get her will fully done, because she just got one of those will kits online and everything else. But I have recently found out, because it is not stated in the will what sort of fee I'm supposed to be getting as an executor, I'm just doing this out of the goodness of my heart, and I am not getting paid for my services. It needs to be stipulated in the will in order for that executor to get a fee. Ross put in the comments about passwords and credentials and all that kind of stuff. In this day and age, all of the utility bills are being emailed to people, and now all of a sudden all of these bills are coming to her email and I can't access her email. The banks are very difficult to deal with, and yeah, being an executor is a whole different ball of wax. Every estate seems to be different.
Yep.
And definitely a learning experience, that's for sure.
Something we can do, like the collective is we can simplify our situation and create those checklists. Ross was talking about the digital assets checklist. Yeah, that's a very important thing. How do people get into your email? I mean, you should not be using somebody else's credentials to do transfers and things like that. That's inappropriate. But you should be able to get access to those things with the appropriate documentation. And you need to know, beyond the digital assets, what about just the regular assets? Where are they? Who do they contact? What are the account numbers? are they aware you exist? Those kind of things. One other comment I want to have just before I go to Ross. Ross, thank you for mentioning that getting it reviewed by a lawyer. 100% important. I think anybody who's sitting here is beyond the point of using a will kit. My will was done using a will kit when I was sole proprietor, so it was very, very simple. But again, not appropriate for my current situation. The other thing I was going to mention was the where this documentation was done matters. So let's say I got my will and my power of attorneys done in Ontario and I moved to New Brunswick. Those Ontario documents may not be valid in New Brunswick. So that's something else important to consider. Ross, go ahead.
There we go. I had to find the damn well, like Lynn. I had to find the unmute button. I mentioned about said a second lawyer reviewing the will. And the reason I mentioned this, and this happened to my family, the first lawyer wrote up a will. Mother passed away. After when we started doing all this stuff for the will, her will was thrown out because of errors. So have a second lawyer review it to catch any potential errors, because all of our wills at that point, because this lawyer did all of our wills, the whole family's, all of our wills had to be rewritten because of his sloppy work. Yes, so the other side of that equation, and I'm dealing with another one, is intestate. Dad hated lawyers. Dad passed away. I'm still dealing with his estate 2 years later. Because
And the
there
tier
is
three-
no technical estate, but it's there, it's in the bank, it's got to wait until a bunch of other stuff is dealt with because it's so small, it doesn't go to probate. But I'm trying to find my brother, which is he's fallen off the face of the earth. Until that time, I can't touch anything. It just sits in the bank account. I
one
want
thing that-
$5,000.
One thing to consider too is when somebody passes, if things can't be wrapped up quickly, you might end up in a trust situation.
Mhm.
So you might end up in a graduated rate estate trust. That's a trust that's treated and taxed like an individual, but that's only eligible for 36 months. And then it becomes a different kind of trust, which is taxed at the equivalent of the highest personal tax rate until the assets are distributed to the beneficiaries. So, having your affairs in order, having that list,
Yeah.
hugely beneficial.
Yeah.
Kim made a comment that she was recently asked to help with somebody. Kim, I would definitely, take an afternoon and go and sit down with them and make them write down where everything is so that you can, have a little bit easier of a time. Consolidating and simplifying can really help before anything bad happens.
Yeah, it's my mom, so my immediate reaction was yes, because I want to be there for her. But I've never been asked to do anything like that before and have absolutely zero idea what's really involved with it. I haven't really dealt with a lot of death in my family, and have had other family members. I mean, when my father passed, my brother was the executor. And I was allowed to just freely grieve. I wasn't involved with anything at all. My brother looked after everything, so I had no idea what he went through. But this is really enlightening me on, taking some notes that I should start doing some research of what I've agreed to.
Well,
Not that I'm going to change my mind for her, but just that I've sat down and talked to her about a couple things that I knew, but you guys are going into a lot more detail, so.
let me just add into that as somebody who's unfortunately been through that 3 times, once with my mother, once with my grandmother, once with my grandfather. There were executors on one. My sister was the executor on my grandfather. I dealt with everything on my mother. There was no estate. I dealt with everything with my grandpa, helped him through everything because I was the only one with experience. And then my sister took the brunt of it. The better the will, the smaller the family, the more clean it is. It was not very difficult when Rod's father was sick and they were looking at redoing that and redoing Rod's mother's will because there's 7 brothers and they're constantly fighting over everything. I said, absolutely not. I will divorce you if you agree to have any part of that. But my side, my mother's side, it was just small. The lawyer did everything out. My mother had nothing, so there was nothing to distribute, just close everything down. My grandmother, everything went to my grandfather. My grandfather, everything was just split equally between 3 people. And the lawyer handled most of it, and that was in the instructions. So
Yeah.
it's not as scary, but it can be.
Well, Tracy's sharing some of her horror story in the chat there, and yeah, like I mean, there could be stresses, financial stresses that are created due to poor planning and things being tied up in court, things along those lines. So it's
Yeah.
definitely something to keep in mind.
Well,
Yes,
in
my
a
grandmother was
way,
no.
in
Sorry.
a way, I'm sort of lucky, but not so lucky doing my aunt's. My aunt was the executor for her brother, my uncle. His estate was quite large. And there was I think 36 different beneficiaries that were listed on that particular will and estate. Some of them under the age of 18. So then the money had to go into the trusts and all that kind of stuff. So my uncle's was a bigger headache than my aunt's. But unfortunately, my aunt, in a way, she was trying to protect me. She was having health issues that were kept from me. So I didn't know she was as unwell as she was, or else I probably would have pushed a little bit harder to get this will and get her estate properly planned. But yeah, it seems every day I'm learning something new. It's like, what do you mean I can't sell the condo now? So I have to pay my own house mortgage as well as her mortgage until probate comes back. And all of her funds, her life insurance policies, everything else, everything is locked up right now until probate comes back. So yes, as executor, I'm responsible for all of her debts until such time those funds can be released. And
Right.
according to my lawyer, right now, turnaround time is about 6 to 8 months. So I am incurring basically 2 households in expenses right now because I've been named as the executor of that will.
My stepfather preempted a bunch of that. Because when he passes, he's now the other half of my mother and my stepfather. So the estate finally clears out through that. He put my sister on as co-owner on everything so that when he passes, she can clear his will without having the problems with my mother's will. And what you're just saying, if it goes to probate, all these bills still going to be paid. Guess what gets locked during probate? All the bank accounts. So
Yeah.
those credit
It-
cards, the lines of credit,
I'm
all
not
that
a
just
lawyer, so I don't want to speak to that adding people on title. It is something I'm consulting a lawyer about because obviously since getting married, I have some adjustments to make. So
no,
there's definitely something there.
Yeah.
no,
But
the
sorry,
lawyer
but
said that was fine to add her to title for his
it also
TFSA.
depends on the
every-
province and the
It's
value
Ontario.
of properties. Yeah, I know, because Alberta, you can do it without question. But yeah, and so my sister was on everything bank account. So, but it does vary per province, and there's certain restrictions around them per province. But we've got 3 minutes. I say that we launch the second poll right now. And
Okay.
if anybody wants to stay on
gonna-
to continue.
I'm gonna just, if it's okay, I'm just gonna whip through these last few slides.
Okay.
Exiting your business, be aware you might have an earnout period where you need to be an employee of the business to facilitate the knowledge transfer. There may be a holdback that is dependent on how many clients stick around, your team sticking around, things like that. It can be a lot of difference. And there can be serious implications if you don't have a will, POAs, or succession planning. There can be massive, massive problems. You can either, it can be the difference between leaving your family set for the rest of their lives or leaving them with nothing but a big tax bill. So something very important to consider. I don't think there's time to really flip through these as fast, but just going back to the tax implications. Closure, you get no compensation. It sucks. Asset sale is the second best option. You're going to pay capital gains tax. You're going to pay more tax than you need to. Share sale is the big one because that's where you get all the incentives as a small business owner.